Everyone, hello, good evening. Yes, everybody, I hope you all are doing well. And let me tell you that I am also good, except my voice. My voice is little hurting me, my throat. Yes, I hope you all are doing well. And we are in the last but one unit of chapter number 5. Sorry, chapter not 5, chapter number 9. Chapter number 9, which is international trade. So international trade mein, we are doing unit number 5. So what we covered in unit number 1, 2, and 3, sir? In unit number 1, we discussed about why international trade, what are the significance of international trade, what are the theories in international trade. Unit number 2, mein, we discussed about various tariff regulations, and unit number 3, mein, trade negotiations. So we discussed about many trade negotiations here, which are required to understand the international concept. Now, unit number 3 no might not be so important one, but unit number 4 is of important one, very important one. In unit number 4, we are mainly discussing that key. So what is the exchange rate and the economic effects? Okay, एक second. I cannot share the screen here. Some issues. Just 1 minute. I'll be back. Huh. Yes, the exchange rate and economic effects that we are discussing now. Exchange rate and economic effects. Introduction May. So what we have to study in introduction, each day we get fascinating news about the currency which fuel our curiosity. So when you read that, there is something about the currency which is given in the newspaper. Obviously, we have some curiosity here. What might be that? What is that giving? What is what it is saying, and how these currency rates, rupee, dollar, that how it changed, sir? Such as rupee gains 12 paisa against US dollar, dollar spot forward rates plummets, the rupee down, euros hold steady, like this. There are many points which will fuel our curiosity. Pound strengthens, etc. Ever wondered what these jargons mean? We shall try to understand a few fundamentals related to the currency transactions in this unit. So specifically, we are discussing about currency transactions. Why there is currency transactions and why this happens. In chapter 3, we examine the demand for and supply of domestic currency. We have not discussed it yet, but it's not chapter 3. It is chapter 1, 2, 3, 8. It is 8. It's actually chapter 8. We examine the demand for and supply of domestic currency. It is not domestic currency alone that we need. Households, businesses, and governments in India, for example, buy different types of goods and services produced in other countries. The it's not just the domestic currency alone that we need. Households, business, and the governments in India all of us, we need the currencies. Why? Because we buy different types of goods from other countries. We purchase different kinds of goods and services from other countries. Similarly, residents of rest of the world, they purchase, buy goods and services from residents in India. Correct? No, we purchase from them and they purchase from us. Example, if we are purchasing from them, think, if we are purchasing from them, purchasing some goods, what we have to pay? We have to pay rupees? No, we have to pay dollars. When they are purchasing from us, they are not required to pay dollars, but they have to pay rupees. So that we have to have dollar to pay them. That means we have to get the dollars from somewhere. Okay, to get the dollars, we have to give something. That means money. We have to give money here. Now, how much money I have to give to get $1, sir? How much money I have to give to get $1? That is the question. So that is the main question here. Correct? No? Yes. So foreign investors, businesses, and governments invest in our country just as our national invest in other country. In a same way, lending and borrowing also take place internationally. So lending and borrowing. So we are borrowing some money and we are lending some money to others. Correct. Borrowing is also there. We lend also. These are these and similar other transactions give rise to an international dimensions of money, which involves exchange of one currency for another currency. So obviously, to borrow some money, I will borrow and I have to repay. No. Example, if I borrow dollar. Example, if I borrow money from US, dollar. Can I pay dollar to purchase some machinery in India? Not possible. If I'm purchasing any machinery in India, I cannot pay them dollar. I have to pay them rupees. So if I borrow dollar, and I have to give somewhere, I have to give the dollar, and for $1, I have to get some return. That is money. Now, how much money I will get? Obviously, this entails the market transaction involving determination of price of one currency in terms of another currency. Obviously, we have to get some idea that what is the value of one currency in terms of another. So for that, we need the exchange rate. Example, $1 is equal to 83 rupees. Rupees 83. $1 is equal to rupees 83. This is exchange rate, Baba. This is exchange rate. Okay. So now a foreign currency transaction is transaction that is dominated in or requires settlement in foreign currency. So denominated, not dominated, denominated. It might be denominated in other currency. Foreign exchange transactions. Example, if I'm purchasing imported guitar, if I'm purchasing a guitar that is from importing a guitar, then I have to pay their currency. So it is denominated in their currency, in other currency, or require settlement in foreign currency, including transactions arising when enterprises either buys or sells the goods. For that, we have to settle. If we buy the goods, we have to settle. If we sell the goods, we have to receive. Obviously, we will receive in foreign currency. So whose price denominated in a foreign currency, not in rupees, but in dollars, example. That is foreign currency. Borrowers or lends. Borrowers or uh, borrowers or lenders funds when the amounts payable or receivable are denominated in a foreign currency becomes a party to an unperformed forward exchange contract. So in all these cases, plus forward exchange contract. What is forward exchange contract? We decide in earlier that in future, for example, I will purchase $1 in future. After 3 months, I will purchase $1 for 83.2. Right now, dollar rate is 83. In future, I will purchase this dollar for 83.2. Now, you might ask me the question, sir, if it is 83 now, then why you will purchase at 83.2 in the future? Because I don't want dollar now. I don't want dollar now. I am purchasing some goods in the future. I believe that I am sure that I am purchasing some goods in the future. So that I am ready to pay 83.2 in the future. But I have done one research and I know that it is going to be 83.5 in the future. So I saved 0.3 per dollar. No? I saved 0.3 per dollar. That's why we go for forward exchange contract. If we are doing forward exchange contract, there also we require some money. So that exchange rate, there also we use exchange rate. Otherwise, acquires or disposes of assets, acquiring or disposal of asset. If I am purchasing land in foreign country, if I am purchasing land, I have to pay them, no? For that, I require dollars. I require dollars. These are the requirements of dollar. For what I require the dollars. Now, who will set this exchange rate? $1 is equal to 83 rupees. Sir, who is going to set this exchange rate? Question mark. Usually we'll get this question mark. Sir, who is going to set this exchange rate? The exchange rate regime. India decides the exchange rate regime where the exchange rate is set either by the government or by the demand and supply in the economy. So usually exchange rates are determined by demand and supply. If there is more demand, price will be more. If there is less demand, price will be less. If there is more supply, price will be less. If there is less supply, price will be more. Remember this in chapter 4, May we discussed. Okay. But governments can influence those exchange rates. Usually it is by demand and supply. Usually it is by demand and supply, but government can influence. So government will influence. Usually government will influence the price in various ways. We will discuss about that. The extent and nature of government involvement in currency markets define alternative system of exchange rates. So there are alternative exchange rate systems. So we will discuss in this section, we will examine some common system and explore some of their macroeconomic implications. So we will explore some of their macroeconomic implications. What is macroeconomic implication? Their effect on macroeconomy. So our economy as a whole. So how it will put some effect. There are three broad categories of exchange rate system. In one system, exchange rate are set purely by private market. That means government will not interfere. Government is not going to interfere purely by market forces with no government involvement. This is first system. Purely by market, no government. Value change constantly as demand for and supply of the currencies the fluctuate. It is not fluctuate, fluctuate. Fluctuate. As and when demand and supply fluctuates, the price, the foreign currency price also fluctuates. The second system, in another system, currency values are allowed to change, but governments participate in currency markets in an effort to influence those values. So to influence those values, in an effort to influence those values, the government participate in currency markets. Earlier in first system, they don't participate at all, but here they participate. Finally, governments may seek to fix the values of their currencies either through participation in the market or through regulatory policies. Okay. In another system, the currency values are allowed to change, but government will participate. System number 1. Okay. First system, purely market. System 2, it is mixture of market and government. System number 3, purely government. Ashte. Government will set here, here market will set. This is mixture. That means market will set, but government participate. Government will do something and it will participate. Okay, it will participate to change. It will participate to change the value. So this is third system. An exchange rate regime is the system by which a country manages its currency with respect to the foreign currencies. So the country manages its currency with respect to foreign currencies. So while considering foreign currency, no, they are managing their currency. This is nothing but exchange rate regime. Again, we have to manage our exchange rates. So $1 is equal to 83 rupees. think it was $1 is equal to 83 rupees. Now, today, $1 is equal to 82. This is good for Indian economy or bad? It is good. Why? Because earlier we had to give 83 rupees to get $1. But now we have to give only 82 rupees to get $1. That means we have improved. Indians, we have improved. So this is one exchange rate. Who must be concerned about this? Each country, both the countries, they are concerned about this factor. Dollar America. So they want it to increase. 83, 84 होना चाहिए, 85 होना चाहिए, 90 होना चाहिए, 100 होना चाहिए. They want it to increase. But we Indians, we want it to decrease. That means our power capacity has to increase. It refers to the method by which the value of the domestic currency in terms of foreign currency is determined. So there are two major types of exchange rate regime at the extreme ends, namely free floating exchange rate. That means market. Market will decide here. That is also called as flexible exchange rate and fixed exchange rate. That means purely by government. This is by market. This is by market. And this is by government. Market and government. In a free floating exchange rate system, governments and central banks do not participate in the market for foreign exchange. Foreign exchange market में the government, central government or central bank, which is central bank, RBI. Government and central bank, they don't participate. They will not participate. The relationship between the governments and central banks on one hand and the currency market on other hand is much same as typical relationship between these institutions and stock markets. Just like stock market, they just regulate, but they don't put more interest. They don't take more interest. Governments may regulate stock markets to prevent fraud, but stock values themselves are left to float in the market. Correct. Stock values are not considered, or stock values are not set by SEBI. What SEBI or government will do? They just regulate it. Fraud should not happen. So that regulation will be there, but they don't set the price. A free floating system has the advantage of being self-regulating. एक minute. Not able to connect here. Wait. Stop sharing. Yes. So free float is self-regulating. That means demand and supply will regulate the price automatically. There is no need for government intervention if the exchange rate is left to the market. The intervention from the government is not required. It is self-regulating. Okay, sir. The market forces also restrain large swings in the demand or supply. Suppose, for example, that a dramatic shift in the world preferences lead to sharply increased demand for the goods and services produced in Canada. So the dramatic change, huge shift in the world preferences to Canadian product, no, that shifted the demand of people from rest of the world to Canadian goods. This would increase demand for Canadian dollars. The Canadian dollars ka price, no, that got increased. Raises Canada's exchange rate and make Canadian goods and services more expensive for foreigners to buy. So it is expensive for foreigners to purchase that goods because Canadian goods are expensive. How, sir? Because Canadian dollar is expensive. Okay. Some of the impact of swing in foreign demand would thus be absorbed in a rising exchange rate. In effect, a free floating exchange rate acts as buffer to insulate an economy from the impact of international events. That means automatically it keeps regulating. If some changes which happens in international market, that will automatically get reflected in the price. The price, that is exchange rate. So the primary difficulty with the free floating exchange rate lies in their unpredictability. So if it keeps changing, it is very difficult to predict for the future. Correct? No, it is very difficult to predict that what might happen in the future. Yes. So what might happen in the future, sir? That is very difficult to predict. So that's why it is unpredictability. So you can never predict what might happen in the future. So contracts between buyers and sellers in the different countries must not only reckon with the, the possible changes in the prices and other factors during the lives of those contracts. So we are not just we are not just seeing the prices here. It has to be seen from other factors also. They must also consider the possibility of exchange rate changes. See, not just the price of the product, we have to see possibility of exchange rate changes also. I'll give you one simple example. You just listen to me, listen to this example here. See, I made a contract. What I've done? A contract with Mr. Steven. Mr. Steven from Hong Kong. Hong Kong. Hong Kong. That he will supply 2000 kg of material X every month. Material X every month, and I have to pay $10,000 every month. Every month. That was continuing order or standing order. So this is a standing order. See, this won't change. Every month this is same. But exchange rate changes, no? So I have to purchase. That means I have to pay 10,000. I have to pay $10,000. Example, first month, I have to pay that person $10,000. But exchange rate where $1 is equal to 83. Exchange rate was 83. Now I have to pay 83,000. Correct? No. Second month, I have to pay him $10,000. I have to pay him $10,000, but $1 is equal to 83.5. Example, multiplied by 83.5, 83,500. I have to pay 83,500. Second month में $10,000. $1 is equal to 83.5, 83,500. Third month में I have to pay $10,000, but $1 is equal to 84 rupees. I have to pay 84,000. See, foreign exchange, this contract is not changing, but because of this, this is changing now. 83 से 83,500 हुआ, 83,500 से 84,000 हुआ. अरे, you are getting the difficulties. This is not changing, but this is changing, no? So that makes, yeah. So we are not only reckon with the possible changes in the prices and other factors during the exchange. I'm not worried so much about that. They must also consider the possibility of exchange rate changes an agreement by an Indian distributor to purchase it. We just saw that example. Okay, continue. The certain quantity of used goods each year, for example, will be affected by possibility that the exchange rate between the Indian rupee and US dollar will change while the contract is in effect. So I told you, contract is there, 10,000, 10,000 is happening, sir. Every month I have to pay $10,000. What if this dollar rate changes? It was 83, now dollar 8 is 82. So then I have to pay 83K and 82K here. जा रहा है दिमाग में? Yes, sir. Some managed float system, governments and central banks often seek to increase or decrease their exchange rates by buying or selling their own currencies. Sometimes central bank, no, they purchase, they sell their own currency. So this is called as managed float system. So who will manage, sir? The government. Our central government will manage this system just to have a stable exchange rate. So exchange rates are still free to float, but governments will try to influence their values. Free float, we discussed about free float. Till now, we discussed about free float. Now we have to discuss about managed float system. Government or central bank participation in a floating exchange rate system is called as managed float. Actually, it is floating. That means demand and supply. Demand and supply will decide the price. Exchange rate. Demand and supply will decide the exchange rate. But here, to some extent, for some reason, the government will participate. The government will participate. So this is called as managed float system, not free. Countries that have a floating exchange rate system intervene from time to time in the currency market in an effort to raise or lower the price of their own currency. Government usually, sometimes, many a time, government will interfere just to manage the price of their own currency. Typically, the purpose of such intervention is to prevent sudden large swings in the value of the nation's currency. Such intervention is likely to have only a small impact, if any, on exchange rates. So even if there is large surge or swings in the price, the government will try to reduce that. Government will try to reduce it, and they are trying to manage that swing here. Still, governments or central banks can sometimes influence their exchange rates. So suppose the price of country's currency is rising very rapidly. Price of currency in is rising very rapidly. Price of some countries, the price of their currency is increasing very rapidly. The country's government or central bank might seek to hold off further increase in order to prevent a major reduction in the net exports. See, there are example. I'll first give you the example. Later, we'll come to this point again. Okay. Example. Example. We are producers of think. We are producers of wheat. We are the producers of wheat. 1 quintal wheat. 1 quintal is wheat is equal to example 3,400 rupees. Think rupees 3,400. Okay. Think that $1 is equal to 68 rupees. $1 is equal to 68 rupees. If we are exporting 1 quintal, if we are exporting 1 quintal, then how much dollar I have to receive? How many dollars? How many dollars I have to receive? How many dollars I have to receive? 3,400 divided by 68. Nothing but $50. Correct? No? $50 I have to receive. Yes or no? Yes. 3,400 divided by 68 is equal to $50. Correct. I have to receive $50. That means foreigners, no, they have to pay me $50. Foreigner has to pay me $50, no. Correct. So foreigner has to pay $50. I receive, he has to pay. Now what if $1 $1 is equal to not 68 rupees, not 68 rupees. For example, what if it is 82 rupees? $1 came 3,400 divided by 82. So he has to pay. If I export 1 quintal is equal to dollar, if $1 is equal to 82, then he has to pay me 41.46. 41.46. Now my major question to you is, from here to here, our rupee value has increased or decreased? My major question to you is, if rupee value has increased or decreased? It has decreased. It has decreased. Now you might think that, sir, $1 is equal to 68. Now $1 is equal to 82, no? That means it has increased, no, sir? No. It is actually decreased. I'll give you one example. One Rocky Bhai is equal to how many villains? Actually, Rocky Bhai is villain. I'm so sorry. Rocky Bhai is a notorious killer. He is. Okay. That my students already know why I hate him. Hey, no, I'm so sorry. I'm not hating Yash here. I'm not hating Yash. But the movie में some senseless things are there. Baseless. I'll tell you one incident which one scene in that which I always tell to the students that, so one coin, one gold coin, accidentally or some purposefully, it went to police station. Police station. And what this Rocky Bhai did, what this Rocky notorious killer, notorious guy, what this Rocky Bhai did with some, okay, what is this? Cigarette. Cigarette. This is his hairs. Okay. Rocky Bhai, he came with machine gun and they call it as Dodama. He came with machine gun, big gun it is. And he started firing on police station. He started firing on police station. This is Rocky Bhai. He started firing on police station. Now you tell me. And what happened? What happened in the theater? What happened in the theater? Theater was filled with students. I'll tell you. The theater is filled with students. Theater is filled with students. And this notorious guy, he started firing on the police station. Now you tell me, what message is given to all these students? All these guys. What message is given to all these guys? If you do these kind of things, you will get whistle, claps. And we think that he is the hero. We think that this guy is hero who is firing on police station, and we get entertainment by seeing that police station pe the guy is firing. This so-called hero, he is firing on police station. Now, what is the message given to the students or general public? If you want to get something, there is no formal way. You have to go to informal way. What Rocky Bhai could have done? He had to go through the law. He has to follow law. He had to follow law, and he had to take that. He has to take that coin. if he wants it, so really he wants it, he has to prove that he is the true owner of that coin, and he has to take that. As per law, he has to take it. But what he has done, firing on the police station, the public property, police station is public property, किसी का बाप का property नहीं है वो. It is not the property of any a person. If it's not the property of a person, it is public property. And in a film, it is projected that you can fire on the police station. I don't support this because police station belongs to public. It is the public property. किसी का बाप का property नहीं है वो. And we have to ban these kind of films. Huh. One Rocky Bhai is equal to 83 members, 68 members. 68 members. Now, one Rocky Bhai is equal to 84 members. Now, who became strong? Rocky Bhai or this 68 members? Rocky Bhai became stronger, no? He went to gym and he became more strong. And he can kill more innocent people now. Earlier, he could kill 68 innocents. Now, one Rocky Bhai, 84 innocent guys. Okay. Who became strong? Rocky Bhai became strong. And who became weak? These guys became weak from 68 if it is dollar and if it is rupees. So rupees became weak. So rupees became weak. So that here the value of rupee has decreased, guys. The value of rupee has decreased here. But value of dollar has increased. The value of dollar has increased, but value of rupee has decreased. So that we know. Okay, that's why. Okay. 1 quintal. So now 1 quintal is equal to 41.46 dollars. This has become cheaper, no? So if earlier 1 quintal was $50 to the foreigner, now 1 quintal is equal to $41.46 to the foreigner. So this he has to pay less amount. If the price decreases, then the quantity increases. That means exporting increases. What if Indian rupee value is increasing? Example, earlier $1 is equal to 68. Now, right now, $1 is equal to 34. Think, $1 to 34. 1 quintal is equal to 3,400. So earlier, this foreigner had to pay me how much? $50. Now he has to pay me, the same guy, he has to pay me $100. For that person, this became costly. This became costly to that person. If this becomes costly to that person, then the demand reduces, so that exporting reduces. Export will reduce because the goods will become costlier to the foreigner. So what is the conclusion? Conclusion, if rupee value increases, then export decreases. If rupee value decreases, then export increases. Export increases. If rupee value decreases, then export increases. Or I can say that, what is the meaning of decrease in rupee value? Increase in rupee value. If rupee increases, that is equal to dollar value decrease or foreign currency value decrease. If rupee value decreases, that means dollar value increases. Correct? No. Rupee value increased. That means dollar value has increased. Dollar ka value has increased. Keep this in mind. So on that basis, we have discussed here. Okay, this is the conclusion. Rupee value increases, the export in the export. Are we interested in decreasing the export? No, that's why, see, suppose the price increasing very rapidly, the country's government or central bank might seek to hold off further increase. Sir, increase adre ಒಳ್ಳೆದಲ್ಲ? Yes, it is good, but they should not be more than beyond a certain limit. Why, sir? In order to prevent a major reduction in the net exports, to reduce the reduction in the net export or to increase the net export, they have to reduce the increase in the price. An announcement that a further increase in its exchange rate is unacceptable, followed by the sales of that country's currency by the central bank in order to bring the exchange rate down. See, I'll tell you, people, everyone, 100% attention here. Listen, the government in their reserve, foreign currency reserve, in their foreign currency reserve, there is foreign currencies. They have some foreign currencies. If you tell me if supply of dollar decreases in India, if supply of dollar decreases in India, then the dollar value, supply has decreased, no? That's why dollar value increases. If dollar value increases, increase in dollar value, agree that increase in dollar value is equal to decrease in, increase in dollar value is equal to decrease in, wait, correct, supply of dollar decreases in India. That means dollar value, Indian rupee value, Indian rupee value decreases. If dollar value increases, then Indian rupee value decreases. Agree with this? Yes. Correct. No. So, to increase the rupee value, what foreign currency, what the government does? Government will increase the supply. Government tries to increase the supply. So, supply of dollar decreases in India. If the supply of dollar decreases in India, so dollar value increases. Why? Because the dollar is in shortage. So everyone is asking for dollar. So the dollar value starts increasing. So if that increases, rupee value decreases. Rupee value decreases here. That's why the foreign currency reserves which are there with the government, that increases. No, I mean that they will start selling. So an announcement that further increase in its exchange rate is unacceptable. Increase in exchange rate is unacceptable. That means increase in exchange rate. $1 is equal to 83. Now $1 is equal to 84. Sir, beyond that 84, we are not accepting. So that what they do? The central government or central bank, in order to bring its exchange rate, can sometimes convince other participants, wait, the country's currencies by central bank in order to bring the exchange rate down. So supply of wait, there is some sentence missing, or I am missing that. Listen. An announcement that a further increase in its exchange rate is unacceptable, like this. That is unacceptable, followed by sale of that country's currency by central bank. That means central bank will increase the supply of dollars. Supply of dollars they will increase in order to bring its exchange rate down. See, if the supply of dollar is more, then exchange rate starts reducing. Exchange rate will again come back to 83. Or they can convince some other participants in the currency market that exchange rate will not raise further. So they will convince them that don't raise the exchange rate further. That change in expectations could reduce the demand for and increase the supply of the currency, thus achieving the goal of holding the exchange rate down. So what they do, they try to increase or decrease the exchange rate so that they try to hold that exchange rate down. So this is their idea. Once again, people, everyone listen here. So there is government. Government has some foreign currency reserve. Example in that they have yen, yen, Japanese yen. Okay. So if they want to, Japanese yen. Now, supply of yen, supply of yen is more in India. Think that supply of yen, it does, the price of yen, exchange rate of yen reduces. Price of yen reduces. Okay. Value, not price. I can say that the value, not price, but it is value. Value of yen reduces. Now you tell me, if there is reduction in the value of yen, that leads to what? That means there is increase in value of rupee. Agree? There is increase in value of rupee compared to yen. If the value of rupee, if there is increase in value of rupee, that leads to dash. Increase in value of rupee, that is equal to, first, if there is increase in value of rupee, export, what happens to export? Export reduces. Agree? Correct? No. Value of rupee increases, export reduces. See, if rupee value increases, then export reduces. That we discussed already. If government doesn't want to reduce the export, export has to increase, sir. If the value of rupee reduces, increases. If the value of rupee increases, then export reduces. So what is the main reason here? Supply of yen is more. What they do? Government will do, they will take back, they will go on purchasing yen from the market. Whatever the supply of yen which is there in the market, they go on taking it back. So the yen will get back. So the government will take back yen from the market. So supply of yen reduces. Supply of yen reduces. That is equal to value of yen increases. Okay. If value of yen increases, that is equal to value of rupee. Value of rupee decreases. Sir, if value of rupee decreases, then export from India, export from India increases because the price is less, no? That's why export from India increases. So these are some of the issues which are given in that point. एक second, guys. everyone. I'm so sorry. There was some internet issue. I just relocated my modem now. Sorry. Basics में iPhone share. So yes, so this is about. So that's what we were discussing about the free float system and float system, float and free float methods. Okay. So next one is fixed exchange rates. So the name itself says that it is fixed by the government. Government will fix this rate. In fixed exchange rate system, the exchange rate between two countries is set by the government policy. There are several mechanisms through which the fixed exchange rates may be maintained. That means purely maintained by the government. The government will maintain or set the exchange rate here. This is called as fixed exchange rates. So whatever the system for maintaining these rates, however, all the fixed exchange rate system shares some important features. So there are some important features in fixed exchange rate, fixed rate regime. So in an open economy, the main advantages of a fixed rate regime are, sir, what is fixed rate exchange rate regime? Which is fixed by the government. Government is going to fix that. This is fixed exchange rate regime. So what are the main advantages? First one, a fixed exchange rate regime avoids the currency fluctuations and eliminates exchange rate risk and transaction costs that can impede the international flow of trade and investments. Very much important one. Remember that in case of fixed exchange rate regime, so fluctuations are not there. Why? Because the government will give some notifications and they will fix it in advance. So that's why there is no overnight fluctuations. Just like stock market. Stock market means the prices of the stock, overnight fluctuations will happen here. These kind of overnight fluctuations won't happen. International trade and investments are less risky under fixed rate regime as profits are not affected by the exchange rate fluctuations. So the exchange rate fluctuations are very less. Why? Because it is everything is fixed now. So when it is fixed here, so it is not going to affect. So it will not affect the, yeah, it is not going to affect the profits. So why? Because in advance, I can, what I can do in advance, I can set the price, or I can, in advance, I can predict what might happen in the future. A fixed exchange rate can thus greatly enhance international trade and investments. Okay, next one. In a reduction in speculation on exchange rate movements, if everyone believes that exchange rate will not change. See, for example, if exchange rate keeps changing, today the price is 83, tomorrow the price is 83.4, day after tomorrow 82. If this happens, this is fluctuating now, fluctuating exchange rate. What I'll do, I'll purchase at 83, I'll sell at 83.4, I'll purchase at 82 and I might sell at 83 again, like this. This is what is my business? Purchasing and selling, making profit by purchasing and selling. So this is called as speculation. So that speculations won't be there because everyone knows it is fixed one. The rate is fixed. A fixed exchange rate system imposes discipline on countries' monetary authority and therefore is more likely to generate lower level of inflations. Why? Because the monetary authority is going to fix that price and they know when to set the price and when not to set the price, or when to set high price or when to set low price. So that's why the government will take care of everything. The government can encourage greater trade and investment as stability encourages investments. So the government can think of stability. Correct? No, fixing the exchange rate means there is no fluctuations. Every now and then there is no fluctuation. So there will be a stability. Exchange rate peg can also enhance the credibility of the country's monetary policy. So if there is a fixed exchange rate, so there is no fluctuations, the credibility of the country that will increase. However, in the fixed or managed float exchange rate regimes, the central bank is required to stand ready to intervene in the foreign exchange market and also to maintain an adequate amount of reserve, foreign exchange reserve. They have to maintain foreign exchange reserve. Remember here, we discussed here, if there is great supply, so there is great supply, the foreign exchange reserves. So what government has to do, they have to purchase this from the open market. They have to purchase. That means they have to keep that in the reserve. And here we discuss that they will increase the supply. They have to increase the supply. That means they have to sell the foreign exchange reserve. Why? Because supply has decreased, because of which value has increased now. So they have to increase the supply now. To increase the supply, they have to have some amount of foreign exchange in their reserves. So that's why they need to have some reserves. Very important point. They need to have some reserves. Next, basically, the free float or flexible exchange rate regime is argued to be efficient and highly transparent as exchange rate is free to fluctuate in response to the supply and demand. See, in case of free float and managed float, it was very much transparent. Oh, I can get to know that if there is increase in the demand, if there is increase in the demand, there will be increase in the price. If there is increase in the price of the exchange rate, if the exchange rate increases, then definitely I'll get to know that the exchange rate has increased. Because of increase in the exchange rate has increased. Why? Because the demand has increased. It is very transparent. But if it is fixed by the government, I will not get to know what kind of godala or fraud might happen. Fraud might also happen. So and it clears the imbalances in the foreign exchange market without any control of the central bank or monetary authority. A floating exchange rate has many advantages. What are the advantages of floating exchange? A floating exchange rate has the greatest advantage of allowing a central bank and or government to pursue its own independent monetary policies. So what they can do, they can have their own independent monetary policies. So they can have their monetary policy. Why? Because they are not required to put their brain on fixing the exchange rate. They can completely isolate from fixing the exchange rate. They can fix the rate as per their needs. Floating exchange rate regime allows the exchange rate to be used as policy tool. For example, policymakers can adjust the nominal exchange rate to influence the competitiveness of the tradable goods sector. Competitiveness. See, the floating exchange rate regime allows the exchange rate to be used as the policy tool. Why, sir? For example, policymakers can adjust the nominal exchange rate to influence the competitiveness of the tradable goods sector. Now, for example, if there is floating exchange rate system, automatically we will use that for as a policy tool. So if there is increase in the demand for foreign exchange, so if that increases, no, then obviously there is more value for that currency and the value for our currency will reduces. So that we have to use some policy tools. So use some policy tools to increase the value of our currency. So that is given in point number 2. As there is no obligation or necessity to intervene in the currency market, the central bank is not required to maintain a huge foreign exchange reserve. Why? Because we are not the government will not interfere. Government will never interfere in the market. So if government won't interfere in the market, what happens, sir? So they don't have to buy and sell in the market. It is self-regulating. Market is self-regulating. So that is the greatest advantage. But what is the greatest disadvantage of a flexible exchange rate regime? Is that volatile exchange rate generate a lot of uncertainties in relation to international transactions and add a risk premium to the cost of the goods and assets traded across the borders. So what is the disadvantage? So it is highly volatile. Highly volatile. Every now and then, minute by minute, it will change. Currency market. Minute by minute, it will change across the border. So in short, a fixed rate brings in more currency and monetary stability and credibility, but it lacks flexibility. On contrary, A foreign rate has greater policy flexibility. Fluctuating rate is floating rate. It is floating rate has greater policy flexibility but less stability. The stability is very less. Fluctuate, see, both has pros and cons. Floating rate more flexible but highly fluctuating. But in case of fixed rate, highly stable, but it is not flexible. It is stable, but it is not flexible. Whenever we want, we cannot do any policy changes. Credibility is also very less here. Okay. Now, foreign exchange market. Listen. Very important one is foreign exchange market. Wait. If I go to, I'll see to it that whether you can see the foreign market from here. Oh, no, it is not possible right now. It is I'm not getting access to that. If it is possible, I could have shown you what is the foreign market. No, not possible. That's okay. Huh. The foreign exchange market. The forex market participants mainly are, who are forex participants? Can I purchase and sell, sir? Yes, I can. If I am a dealer, I can purchase and sell. Can other participants, such as, is there any other participants? Yes, it is commercial banks executing orders from exporters, importers, investment institutions, insurance and retirement funds, hedgers, and private investors. These are some of the participants who need foreign exchange. So commercial banks also perform trading operations. They purchase and sell trading operations in their own interest and at their own expenses. So they are ready to take the loss also. Daily turnover of largest banks often exceeds several billion US dollars. Billion US dollars में, example HDFC. HDFC bank, they are doing in billion dollars. So they are exchanging in that rate. And many make their main profit by speculative operations with currency. Speculation. So nowadays they are doing more of speculations. I told you what is speculations. Buying when the price is less and selling when the price is more. That is speculation. Okay. Same way, brokerage houses are also playing an important role as contractors between the large number of banks, funds, commission houses, dealing centers, etc. The commercial banks and brokerage houses do not only execute currency exchange operations at the prices set by other active players, but come out with their own prices as well, actively influencing the price formation process and the market life. So here, the commercial banks know they will accept the prices which is set by RBI. At the same time, they have the right to set their own price. Example, I purchase, for example, I'll take commodity. Example, I purchase remote for 100. If I want to sell this, can I set my own price? Yes, I can. Same way, currency mein commercial banks can do this, not me. I cannot do that. Commercial bank, they can purchase the currency and they can set their own prices. That is why they are called market makers. So commercial banks are also considered as market makers or some intermediaries. In contrast to above, passive players like me and you, we are passive players, cannot set their own quotations. Importers and exporters, they cannot set their own quotation and make trades as quotations offered by the active market players. Passive market players normally pursue the following aims: payment of export-import contracts, foreign industrial investments, the opening of branches abroad, or the creation of joint ventures, tourism, speculation on rate differences, hedging of the currency risk, insurance against losses in the cases of unfavorable price changes, etc. So that is our intention. We are not intending to make the market. We are not the market makers. We are just the players in the market. In the foreign exchange market, there are two types of transactions. One is current transaction and future transactions. What is current transactions? Which are carried out in the spot market, and exchange involves immediate delivery Spot market, current transactions immediately. I purchase and sell. What is future? I don't purchase and sell now. I will make a contract for future. I told you, na, after 1 month, I will purchase $1 at the rate of 84. Why I do this, sir? Right now it is 83, but I don't want dollar now. In future, it might be 85. I'll purchase it at 84 and immediately I'll sell it at 85 after 1 month. So I made one contract to purchase it for 84. After 1 month, I made a contract to purchase it for 84. Purchase it for 84. I'm sure that after 1 month, the price will be 85. So I'll purchase after 1 month for 84 and I sell for 85. This is called as future, wherein contracts are agreed upon to buy or sell the currencies for future delivery, which are carried out in forward and or future markets, which are carried out in future. Right now, I'm just making the contract. In future, I might sell it at higher price also. Exchange rate prevailing for spot trading, for which settlement by and large takes 2 days, are called spot exchange rate. So settlement, what is settlement? Within 2 days, the settlement has to happen. That means, for example, I purchase it now, but I'll get the dollar after 2 days. That is called as settlement. There is some settlement differences. So the exchange rate quoted in foreign exchange transaction that specify a future date are called as forward exchange rates. So in future, I will sell you at 84. If you want now, I will sell you at 83. In future, if I sell you at 84. This is called as forward exchange rate. The currency forward contracts are quoted just like spot rate. Just like what is spot rate? Right now, if you purchase, no, it is 83. Right now, if you purchase, it is 83. If you are purchasing in the future, it will be 84. This is spot rate. This is future rate. Spot rate and future rate. So I hope you are getting this. Yes, no? Okay. Yes. However, the actual delivery of currencies takes place at the specified time in future. Just like spot rate, the price will be now, but in future, the price that will be specified, currency takes place at the specified time. The sale happens in the future. So rate we will decide now, but the sales happens in the future. This is called as forward contract. When a party agrees to sell euro, when a party agrees to sell euro for dollars, okay, when a party agrees to sell euro, goodness, huh? On a future date at a forward rate agreed upon, he has sold euros forward. See, in future, I will sell you euros. That is euros forward. It is euros forward and bought dollars forward. For euros, I will purchase dollars. So I bought dollars forward and I'm selling euros forward. Why? Because it is not happening now. A forward premium is said to occur when the forward exchange rate is more than a spot exchange rate. On the contrary, if the forward trade quoted at the lower rate than the spot rate, then there is forward discount. So that can be forward premium or there can be forward discount. So currency futures, um, the currency futures, though conceptually similar to currency forwards and perform the same functions, they are distinct in their nature and details concerning the settlement and delivery. So it's just like forward, but futures are different, forwards are. But in your syllabus, futures are not there, don't worry. So they have discussed only about forward. It looks like forward, but it is not. There is difference. While a foreign exchange transaction can involve any two currencies, Most transactions involve exchange of foreign currency for US dollar. So any two currencies can be there in exchange. So I can exchange any two kinds of currencies. But usually I will exchange one currency for US dollars. Why, sir? Even when it is not the national currency. See, actually, I wanted, euro. I wanted euro. And I have rupee because I'm in India. So I have rupee, I wanted euro. Usually, first I will currency exchange it to dollar and later from dollar to euro. Why I do this? Because dollars are called as vehicle currency because it has high value. In the foreign market, it has high value. That's why first I will convert it into dollar, later I will convert it into euro. Next one, determination of nominal exchange rate. Determination of exchange rate here. As you already know, the key framework for analyzing the prices is the operation of forces of supply and demand in the markets. So we know that demand and supply will play an important role in the markets. Usually, the supply of and demand for foreign exchange in the domestic foreign exchange market determine the external value. Sir, what is given here, sir? I'm not getting. Listen. The supply of dollar in Indian market, that will determine the value of dollar. Sir, again, sir. Huh. The supply of dollar in Indian market, that will determine the value of dollar in Indian market. So the value of the domestic currency, or in other words, a country's exchange rate. So determinants of nominal exchange rate may listen. The value of dollar in Indian market is determined by supply of dollar in Indian market. If the supply of dollar, if the supply of dollar is more, if the supply of dollar is more, then the value of dollar will be less. Why? Because supply is more, no? The value will be less. If the demand is more, then the value will also be high. So individual institutions and government participates in the foreign exchange market. Wait. Okay. Market for a number of reasons. On the demand side, the people desire foreign currency too. For what purpose they will desire to hold the foreign currency? For what purpose they will try to hold the foreign currency? For unilateral transfers such as gift, award, grant, donations, or endowments to make the investment income payments abroad. For what purpose they want to have the goods, sir, or the foreign currency, sir, for making gift. Example, my relative is there outside India. Example, in US, I want to gift some money to that person. Can I gift rupee? No. I have to give dollars, so I'll gift a dollar, award, grants, donation like this. Or to purchase financial assets, stocks, or bonds abroad. If I am to purchase any assets abroad for that purpose, to open a foreign bank account, if I want to have a bank account in foreign, for that also I need foreign capital, foreign money, and for speculation. That means to make small amount of profit by with the help of increase and decrease of the values. The participants on the supply side operate for similar reasons. Thus, the supply of foreign currency to the home currency country results from the purchase of home exports, unilateral transfers to the home country. So investment income payments, foreign direct investments, and portfolio investment, placement of the bank deposit, and speculations like this. For all this purpose, we want that foreign currency. We shall now look into how foreign exchange market work. Similar to any standard market, just like what we discussed in chapter number 4. Can you see this diagram here? This is equilibrium price. Remember equilibrium price we used to calculate in chapter number 4. This is equilibrium quantity where supply is equal to demand. That point is equilibrium point. Henna, this is what we discussed in that chapter, no? Where demand is equal to supply. That meeting point is equilibrium point. So the equilibrium rate of exchange is determined by the interaction of the supply and demand for particular foreign currency. In the figure above, the demand curve and the supply curve of the dollar intersects to determine the equilibrium exchange rate leg with QE as the equilibrium quantity of the dollar exchange. So this is equilibrium quantity and this is equilibrium price. Yes, sir. So change in the exchange rate. Why there is change? Don't worry, a small unit it is. So this is done by somewhere here. Okay. If I do this, this is done. We will do one thing. After this unit, we will go to chapter number 8. Why? Because chapter number 9 may unit number 5. It is purely theory. If you get bored, you just let me know. We will go to some important topic. Okay. In unit number, chapter number 8. Chapter number 7 and 8. So chapter number 7 is quite interesting one. We will go to chapter number 7. Okay. Yes, here. You want a break? Wait, I'll give you the break. Don't worry, I'll give you the break. Wait. See, changes in exchange rates. Changes in exchange rate. Changes in exchange rate portray the depreciation or appreciation of one currency. What is depreciation of one currency? Now, example, $1 is equal to 83. Earlier, $1 is equal to 83. Now, $1 is equal to 85. What is this, sir? Depreciation of foreign currency. Foreign currency got depreciated. Sorry, home currency has depreciated, not foreign currency. Home currency has depreciated, but foreign currency has appreciated. This is called as appreciation and depreciation. The terms currency appreciation and currency depreciation describe the movement of the exchange rate. Describe the movement of the exchange rate. Currency appreciates when its value increases with respect to the value of another currency or a basket of other currency. Again, currency appreciates when its value increases. So what has happened here? Compared to rupee, the value of dollar has increased. This is called as appreciation. But when one currency appreciates, other currency depreciates. Remember, when one currency appreciates, other currency depreciates. On the contrary, the currency depreciates when its value falls with respect to the value of another currency or a basket of other currency. We shall try to understand this with the help of an example. Very good example is given here. For example, the rupee dollar exchange rate in the month of January, $1 is equal to 70. And we find that in the month of April, it is $1 is equal to 75. Now, what has happened? Dollar has appreciated or rupee has appreciated? Dollar. What does this indicate? In April, you will have to exchange a greater amount of Indian rupee, 775, to get the, sorry, not 775, rupees. Rupees 75 to get the same 1 unit dollar. So 1 unit of US dollar. As such, the value of Indian rupee has gone down. Earlier, you had to pay 70 to get $1. Now you have to pay 75 to get $1. That means the value of foreign currency has appreciated, but the value of Indian currency has depreciated. So rupee depreciation here means that the rupee has become less valuable with respect to US dollars. Simultaneously, if you look at the value of dollar in terms of rupees, you find that the value of US dollar has increased in terms of Indian rupees. In terms of Indian rupees, the value of US dollar has increased. $1 will now fetch 75 instead of 70. Same people, what we discussed, no? See, $1 is equal to 70. Earlier, $1 is equal to 70. But now, $1 is equal to 75. That means Indian rupee, the value of Indian rupee has decreased, but value of dollar has increased. Very important one. This is called appreciation in US dollar. US dollar appreciated, Indian rupee has depreciated. Appreciation and depreciation. So you might have observed that when one currency depreciates against another, the second currency must simultaneously appreciate against the first. If this appreciates, then this has to be depreciation. If this is depreciation, then this should be appreciation, like this. To put it more clearly, home currency depreciation takes place when there is an increase in home currency price of the foreign currency. The home currency thus becomes relatively less valuable. The home currency now less valuable. That is home currency depreciation. That means you have to pay more amount. The home currency price has appreciated. Home currency appreciation takes place when there is decrease in the home currency price of the foreign currency. The value of home currency has reduced compared to the foreign currency. So the home currency thus becomes relatively more valuable. So in more clarity, can you see this? If the demand, see home currency depreciation, when home currency depreciation happens, see this is dollar supply, dollar, you can see that it is dollar. Supply of dollar and demand of dollar. See, D1 it is. This is D. That means this is original demand. This is increased demand. So what happens if demand increases? Remember, if demand increases, equilibrium price also increases. Correct? No. This is what we discussed in chapter number 4, unit number 2. Supply being constant. If demand increases, what happens to the price? Price also increases. This is called as appreciation. Under a floating rate system, if for any reason the demand curve for foreign currency shifts to the right, representing increased demand for foreign currency, and supply curve remain unchanged, then exchange value of the foreign currency raises and the domestic currency depreciates in value. Correct? No. This is what happened in the above figure. If the demand for which increases, if the demand for this has increased, supply being constant, then the value of Indian currency has depreciated. Why? Because the dollar price has appreciated. An increase in the supply of foreign exchange, increase in the supply, increase in the supply of foreign exchange. So this is supply, this is demand. Supply has increased. What happens? Now this is the new equilibrium price. This is old one. This is old, this is new. What has happened? Decreased. Correct? No. C. Supply cut to the right side, and as a consequence, the exchange rate declines. It means that the lesser units of domestic currency are required to buy 1 unit of foreign currency, and that domestic currency has appreciated. As we are aware, in an open economy, the firm and household use exchange rate to translate foreign prices in terms of domestic currency. Exchange rate also permits us to compare the prices of the goods and services produced in different countries. Different countries. So why we have to do this appreciation, depreciation, sir? Because we need to know in different countries what is the value. Furthermore, import or export prices could be expressed in terms of the same currency in the trading contract. This is the reason why exchange rate movements can affect international trade flows. So the sentence itself says that the import or export prices could be expressed in terms of same currency in trading contracts. If you know what is the exchange price. So if you know the exchange rates, no, around say you can quote the import and export prices in the same currency. So that's why that is the use of the currency exchange rates. So that is the use of exchange rates. Chalo, we will do one thing. We will take 10 minutes break and we will meet again to continue with this devaluation, revaluation, depreciation, and appreciation. And the impacts. What are the impacts of exchange rate on the domestic economy? So we will discuss about this. And we are done with this unit. We will go to next chapter. So we will go to the chapter 7. I know unit 5 is pending. We will keep that pending. Why? Because too much of theory, sir. So nowadays we are discussing too much of theory. We want one change. So we will definitely go to chapter number 7. So later, after doing one unit, we will come back to this unit. Okay, we have to finish this. Yes. So we'll take a break now. 10 minutes break. This is 7:12, 7:22. Yes, everybody, welcome back. Um, after break, we were discussing about what is depreciation, what is appreciation, like this. Now we have to see that what is devaluation and revaluation, appreciation and depreciation. Sir, if you ask me, sir, is there any difference between devaluation and depreciation? Yes. In both the cases, the value of in domestic currency that will reduce. Guys, in case of devaluation as well as depreciation, the value of domestic currency that will depreciate. But who will depreciate that? I mean, the value of domestic currency will reduces. How it will reduce? That is the question. In case of devaluation, that is deliberate activity. Devaluation, I will devalue. See, for example, if I don't like a person, then I will devalue that person. If he does some act because of which the value is reduced, that is depreciation. Understood? No, sir. I'll explain again. See, if I don't like a person because of some reason, that is devaluation. I don't value that person, devalue. Or because of his own act, because of its own act, something happens, then it is, if it's negative things happens, then it is depreciation. Or putting it in a different way, uh, there is a person, his age is 35 years. Because of his ill act, I will devalue that person. Deliberately, I will devalue that person. If this person, if he's not doing anything, he was a good person. Okay. Scenario two, he's a good person. Because of his age will increase. No, because of his age, automatically the value will get depreciated. So this is depreciation and devaluation. So in case of devaluation, deliberately I will reduce the value. This is called as devaluation. It is willful act. But depreciation, it is not willful act, it is automatic act. Sir, what is revaluation? It is deliberate increase in the value, that is revaluation. Appreciation, that is automatic. So if you read this wordings here, you will get to know. Listen. Devaluation, revaluation versus depreciation, appreciation. Devaluation is a deliberate downward adjustment in the value of the country's currency relative to another country's currency or group of currency or standards. That is devaluation. Deliberately, I am reducing their value. That is devaluation. It is monetary policy tool used by the countries that have a fixed exchange rate or nearly fixed exchange rate regime and involves a discrete official reduction in the otherwise fixed par value of a currency. See, this is one tool which is used by the government, and it is reduction. Monetary authority formally sets a new fixed rate here. So that is under fixed exchange rate regime. So there is floating, managed floating, and fixed exchange rate. In floating and managed floating, it is automatic. But see, floating and managed floating, it is automatic. But in case of fixed rate regime, it is not automatic. It is deliberately fixed by the country, monetary authority. So monetary authority formally sets a new fixed rate with respect to a foreign reference currency or currency basket. In contrast, depreciation is a decrease in the country's currency's value relative to other major currency benchmark due to the market forces of the demand and supply under a floating exchange rate and not due to any government or central bank policy actions. In contrast, depreciation. What is depreciation? It is because of demand and supply. But devaluation, it is deliberate. There is difference between these two. Demand and supply, it is automatic. But in case of deliberate, that means in case of devaluation, it is deliberate activity. Revaluation is opposite of devaluation. Appreciation is opposite of depreciation. So you know this. If you read this, you will understand. Okay, that is devaluation and revaluation. Very important factors. Please keep this in mind. Impact of exchange rate fluctuations on domestic economy. Impacts. So what are the effect of exchange rate fluctuations on domestic economy? The fact that among the macroeconomic variables, exchange rates are perhaps the most closely monitored, analyzed, and manipulated economic measures. So there are many economic measures, example, inflation or employment, unemployment. All these are some of the variables, macroeconomic variables. In that, very important one is this international exchange rate, and it is monitored. It highlights the overwhelming importance of the exchange rate in the economy. The unpredictability of the market caused by the exchange rate fluctuations can profoundly determine a country's economic performance. Knowledge about the possible effect of the exchange rate fluctuations enable us to have an understanding of the appropriateness of the exchange rate policy, especially in developing countries. So if you know what kind of exchange rate it is regime, and you'll get to know that what kind of changes might happen in the future. In the discussion that follows, we shall examine the impact of exchange rate fluctuations on the real economy. What kind of fluctuations in exchange rate that will affect the real economy, we will discuss here. So the developments in the foreign exchange market affect the domestic economy both directly and indirectly. We know this. So development in any change, development nothing but change in exchange rate that will directly or indirectly affect our economy. The direct impact fluctuations in rates is initially felt by the economic agents who are directly involved in international trade or international finance. Direct effect will be on those who are directly involved in international finance or international trade. The fluctuations in the exchange rate have a significant role in determining the nature and extent of countries' trade. See, if countries' trade is not changing at all because of change in the fluctuations in the exchange rate, that means we are not more, it is not changing means that means we don't have more import and export. If import and exports are high, only then these fluctuations happen. Otherwise, no fluctuation. See, if there is no demand for our currency, or there is no supply of our currency outside, or there is no supply of outsider currency inside. When this will happen? If there is no trade. If there is no trade, then these things will happen. Otherwise, this won't happen. No. If there is no fluctuations, that means our nature of our import and export is something that it is very dangerous position. Fluctuations in the exchange rate affect the economy by changing the relative prices of the domestically produced and foreign produced goods and services. So fluctuations in the exchange rate affect the economy by changing the relative prices of the domestically produced and foreign produced goods and services. Remember, when there will be change in the fluctuations in the exchange rate, if the price of domestically produced goods and services changes, only then there is change. One of the major reason. All else equal, that means ceteris paribus, keeping all other things remaining constant. Ceteris paribus ka case they are explaining here. In case of ceteris paribus, an appreciation of country's currency raises the relative price of its exports and lowers the relative price of the imports. That we know. We have already discussed where, sir? We have already discussed that here. Import and exports. Known fact. So conversely, depreciation. So depreciation lowers the relative price of the country's export and raises the relative price of import. For example, assume that there is devaluation or depreciation of Indian rupee from $1 is equal to 65 to $1 is equal to 70. This is devaluation or depreciation that we know. A foreigner who spends $10 on buying Indian goods will post devaluation get the goods worth 700 instead of 650 prior to the depreciation. Little difficult to understand, sir. Let me explain. Listen. Earlier, one guitar is equal to 700 rupees. One guitar is equal to 700 and $1 is equal to rupees 70. Think, it was there earlier. $1 is equal to 70. Now that means a foreigner for purchasing four guitars, how many dollars he has to pay? How many dollars he has to pay to purchase four guitars? $1 is equal to 70. That means $10 for one guitar multiplied by 4, $40. Correct? No. See, 700 divided by 70. That means one guitar is equal to $10. Four guitar is equal to $40. He has to pay. For four guitars, he has to pay $40. है ना? Agree? For four guitars, he has to pay $40. Okay. Now, if I continue, today, एक minute. What is the issue here? Stop sharing. Okay, cool. So now, if $1 it becomes rupees 65. Think if $1 is equal to 65 now. $1 is equal to 65. Then one guitar that will remain same. 700 rupees. One guitar is equal to 700. How many dollars? How many dollars he has to pay now? Question. The question is, sir, how many dollars he has to pay? That is the question. Okay, how many dollars he has to pay? See, one guitar is equal to 7 divided by 65. And divided by 60, 10.77. He has to pay $10.77. What has happened? See, what happens to supply? If price increases, supply will decrease. Supply decreases. I mean, not supply. If price increases, demand will decrease. Why? Because for guitar, how much he has to pay now? 43.0 is equal to 43.7 multiplied by what I've done? 7 multiplied by 4, it will be $43.08 for guitars. Acha. Sir, this is the case. That means export. Our exports will decrease. Our export will decrease. So, in case if it is not 65, if it is 80, if it is $80 from 70, it increased to 80. एक मिनट okay. If that increases to 80 from $70, अब क्या होगा sir? One guitar is equal to 700. One guitar is equal to 700 divided by $80. 700 divided by 80, that he has to pay $8.75. Correct? What he has to do now? He has to pay $8.75. If it is 8.75, one guitar is equal to $8.75, then 10 guitar is equal to, sorry, 4 guitar is equal to how much? Okay. 4 dollars. है ना? It is $35 now. So if it is $35, if that is $35, then earlier he had to $40, sir. Now it is $35. What happens to the demand? Export will increase, but will increase. So it's given here. Importer has to pay for his purchases. An importer has to pay his purchases in foreign currency, and therefore resident India wants to import the goods worth $1 will have to pay 70 instead of 65. For him, this became expense. Instead of 65, he has to pay 70. What happens? Import will decrease. Import will be affected most as they will have to pay more rupee on importing the products. Exchange rate effect affects the economic activity in domestic economy. How it will affect? A depreciation of domestic currency. Just imagine there is depreciation in domestic currency. Just imagine there is depreciation. Domestic currency depreciates. That means, that means export will increase. Export increases. Export increases. But what happens to import? Import will decrease. Why import decreases? For example, earlier for $1, I was getting 65 rupees. But now $1 is equal to 70. One guitar is equal to $10. I'm importing guitar now. $10. That means earlier I had to pay 650 rupees. But now the same one guitar, $10 it is, but I have to pay 700. What happens to the demand? Demand will get reduced. है ना बाबा? Hey Raju. है ना Raju? So says it will reduce. That will reduce. Okay. So the import will get reduced. Import gets reduced. So we have to keep that in mind. Import will get reduced. So depreciation, okay, primarily increases the price of the foreign goods relative to the goods in home country and diverts the spending from foreign goods to the domestic goods. Import will be costlier now, so that we will purchase more of domestic goods. Increase demand both for domestic import competing goods and for export encourages increases, import decreases. If import decreases, we have to purchase that goods from domestic market. It is inevitable that we cannot import, so that we have to depend on domestic market. So that will increase the domestic prices. Domestic price increases, domestic production also increases. For an economy where exports are significantly high, already exports are high, devaluation of home currency, that will add fuel to the fire now. Correct? No. Correct? No. Currency, a depreciation would mean a lot of gain. In addition, if exports originate from labor-intensive industries, increased exports prices will have positive effect on employment. So more exports, that means positive effect on employment. But if it is not employment, we are exporting more of capital intensive goods, sir, then it is employment will still reduce. Employment reduces. Next one, depreciation is also likely to add to the consumer price inflation. How, sir? Depreciation in the value or devaluation in the, remember, here, everyone here, devaluation in home currency. Devaluation in home currency. That means there will be more export, correct? Devaluation in home currency. That means there will be more export. Hana, where we discussed about this? Here. Kaha, sir? Yahan. See, rupee value decreases, export increases. And import. If export increases, import decreases, है ना? If export increases, import decreases. Sir, export is increasing, import is decreasing. That means highest demand in India. So there is highest demand for the goods in domestic market. Why? Export, I want quantity for export also. I want quantity increased. If there is more demand, supply being same, if there is more demand, what happens to the price? Price starts increasing. Price increases. Yes or no? Price will increase here. So that's why it will lead to inflation in the short run directly through its effect on the prices of the imported consumer goods and also due to increased demand for domestic goods. The impact will be greater if the composition of the domestic consumption basket consists more of imported goods. Indirectly, cost push inflation may result through the possible escalation in the cost of imported inputs. Import, see, import is costlier. Even if you import, upon that, the cost of import also increase. Import is costlier, so we will reduce the import and we have to produce more in domestic market. So demand in domestic market increase, demand in foreign market also increase. All together, it is inflation. Altogether, it is inflation. So in such an inflationary situations, the central bank of the country will have no incentive to cut the policy rate as this is likely to increase the burden of all types of borrowers, including the businesses. So all type of borrowers burden will increase. Why? Because cost plus inflation. Everywhere there is inflation, even on interest rate, there is inflation. So this will increase the burden of everyone. The fiscal health of the country whose country's depreciates, whose currency depreciates, fiscal health is likely to be affected with raising exports earnings and import payments and consequent impact on the current account balances. See, everyone here, listen to me carefully. Very important topic that I'm discussing now. I'm just telling you. Okay, wait. Here, listen. If increase in export increases. When, sir? When export will increase? Very simple case. Huh. When export increases, if the value of home currency, value of export will increase, value of home currency decreases, export increases. At the same time, if export increases, import, what happens to import? Reduces. What if import reduces, but the rate of export is less than decrease in import. The rate of export, this is export, rate of export is less than rate of, wait, rate of increase in export is less than rate of decrease in import. अब क्या होगा? What happens? Balance of payment will be worst. Balance of payment will be worst. Why? Increase in export, example, by 5%. 5% increase in the export. Import has not reduced at all or reduced by 1%. 1%. So where is the change here? Instead, there will be worst balance of payment. Why? Because import ke liye we have to pay more. We have to pay more. Getting this? Import pay, we have to pay more. That's why export, increase in export is just 5%. Decrease in import is just 1%. Only 1% in This is very small increase and this is very small decrease. So this should not happen. So that is given here, which says that a widening current account deficit is a dangerous signal as far as growth prospects of the overall economy is concerned. If exports earning rise faster than the import spending, then current account balance will improve. Export raises faster than import, then current account balance will improve. Otherwise, that will be a worst case scenario. So companies that have borrowed in foreign exchange through external commercial borrowings, but have been careless and did not sufficiently hedge these loans would also get impacted as more money is required to repay the loan. We discussed about this already. If you have taken example $10,000 as the loan, think you have taken $10,000 as the loan and every year you have to pay $100 as the interest. $100 as the interest. First month, you paid $100, okay? $100 and $1 is equal to 80 rupees. Think $1 is equal to 80 rupees. Second month, you paid $100, but $1 is equal to 83. अब क्या होगा? What happened here? $1 is equal to 83, sir. You have to pay 300 extra, no? So that is the effect of foreign exchange. The exchange rate fluctuations make financial forecasting more difficult for the firms. You cannot forecast. Every now and then it is changing. So you cannot forecast at all. And the larger amounts will have to be earmarked for insuring against the exchange rate risk. So there will be, this is exchange rate risk, 80 to 83. From 80, it increased to 83. So that 3 rupees increase, no? This is one biggest disadvantage. With growth of investment across international boundaries, exchange rate have assumed special significance. Investors who have purchased a foreign asset or the corporations which floats a foreign debt will find themselves facing foreign exchange risk. So more who are more into foreign exchange transaction, no, they have to face more risk here. Highly risky it is. Why it is highly risky, sir? Because of the reason. What is the reason, sir? The exchange rate fluctuation. It is floating exchange rate that will induce or that will increase the value. That is you have to pay. No? That is a risk actually. For highly cautious before invest exchange rate volatility. If there is highly volatile, I am not ready to invest in that. Today it is 50,000. Tomorrow I am getting the profit of 30,000. Day after tomorrow 10,000. After that 60,000. Again it reduced to 10,000. See, I am not interested in that. If it is fixed one, it is giving me some financial security, then foreigners will invest. So the foreign capital inflows are characteristically vulnerable when local currency weakens. So if the local currency is very weak, then the foreign capital inflows are very vulnerable. Therefore, foreign portfolio investment flows into the debt and equity as well as foreign direct investment flows are likely to shrink. So because of that fluctuation, no, foreign investment inflows, foreign direct investment, FDIs to India, that will shrink. So this shoots up the capital account deficit, affecting the country's fiscal health. Finally, it will definitely affect our fiscal health because the foreign inflows are very less and whoever have invested, no, they will take out their money. So they might take back their money. An appreciation of foreign currency or strong currency or a strong currency or possibly an overvalued currency makes the domestic currency more valuable and therefore can be exchanged for a larger amount of foreign currency. So if my currency is very strong, domestic currency is very strong, then we can purchase more foreign currency. So what are the consequences? Appreciations will have the following consequences. Do one thing. You just go through all these points once and let me know if you have some specific points cut out. I'll be back in just 2 minutes. 2 minutes, I'll be back. You just let me know if there is any doubts. Yes. So an appreciation of the currency, what are the consequences on the real economy of that appreciation. Here, an appreciation of currency raises the price of the exports, correct? Price of the exports, so that the exports will fall. So whatever we have written there, no, ulta, the opposite we will discuss here. Since imports become cheaper, we may expect an increase in the quantity of the import. Export reduces, import increases. Imports increases, exports will fall. Combining these two effects together, the domestic aggregate demand falls, and therefore economic growth is likely to be negatively impacted. So where there in depreciation, there was a positive impact on the economy, but here in appreciation, there is negative impact. The outcome of appreciation also depends on the stage of the business cycle as well. If the appreciation sets in during recession, my goodness, what happens if there is appreciation in recession? Already we discussed that negatively impact on the economy. Economic growth is negatively get impacted. Already recession, it will add fuel to the fire. So the result would be further fall in the aggregate demand and higher level of unemployment if the economy is facing a boom. An appreciation of domestic currency would trim down the inflationary pressures and soften the rate of growth of the economy. The growth of economy will get softened. So an appreciation, see, this is the phase of growth. If it is in appreciation happens during recession, gone. Economy is totally into will fall down. If it is during boom, if this sets in, then it is good. Why? Because it will try to hold on the improvement or the increase in the economic growth. An appreciation may cause the reduction in the levels of the inflation because imports are cheaper. Lower price of the imported capital goods, components and raw materials lead to decrease in the cost of the production, which reflects on decrease in the prices. Prices starts to fall. Additionally, decrease in aggregate demand tends to lower demand pull inflation. So the decrease in demand that will get decreased, so that there will be decrease in the inflation. Living standards of people are likely to improve due to availability of cheaper consumer goods. The consumer goods are available at cheap rate. So what it will do, it will improve the standard of living of the people. Standard of living of the people gets improved. Okay, sir. Wait. So with increasing export prices, the competitiveness of the domestic industry is adversely affected, and therefore the firm have greater incentive to introduce technological innovations and capital intensive production to cut cost to remain competitive. So because of appreciation, now exports are reducing. If export reduces, then the remedy that we have is we have to reduce the cost so that we can reduce the price. See, because of valuation, appreciation, value of our currency has increased. If the value increases, then export reduces. So why this export has reduced? Because of value of currency now. What we will do? We will try to reduce the cost. If cost reduces, then price reduces, so that demand in the foreign market increases. Okay. Next, sir. Increasing imports and declining exports are liable to cause larger deficit and worsen the current account. Again, import increases, export decreases. So we have to pay more outside. To the outsiders, we have to pay more. That will worsen the situation. However, the impact of appreciation on current account depends upon the elasticity of demand for exports and imports. So the elasticity of demand for exports and imports will get impacted. So relatively inelastic demand. We know what is relatively inelastic demand, correct? No, the change in demand is less compared to change in price. For imports and exports may lead to an improvement in the current account positions. So this is one effect. Higher the price elasticity of demand for exports, greater would be the fall in demand and higher will be the fall in aggregate value of exports. So the total value of exports. See, if the elasticity is more, then a small increase in price, high decrease in the what demand, high decrease in the foreign demand. So that will lead to greater reduction in the export value. This will adversely affect the current account balances. From the discussion in this unit, we will understand that all countries would desire to have steady exchange rate to eliminate the risk and uncertainties associated with the international trade and investments. However, nations may sometimes go trade-offs with a weaker exchange rate to stimulate the export and aggregate demand, or a stronger exchange rate to fight the inflation. So we know that the exchange rate which will fluctuate and exchange rate will highly influence the economic condition, but we should have some specific tools or standard tools to fight back. So learners may keep themselves well informed on contemporary exchange rate developments and their implications on the economic welfare of the countries. So who are learners? You, students. Students are the learners. You have to keep yourself informed for contemporary exchange rate developments. That means what is the exchange rate development which is happening nowadays in India and with other countries, that we have to keep updated. So that was about unit number 4. That was about unit number 4. So if you have doubts, I'm open for your doubts. You just let me know if you have any doubts. So I just log into the YouTube and I'll see that if you have any doubts here. I know that guys, these concepts which are there, quite irritating one. It's not an difficult one. It is kind of irritating topics which are included here, but inevitable. New chapters which will give you at least 40 marks, 40 to 50 marks. Obviously, 5 chapters are there, 50 marks. Okay. Yes. So we'll do one thing. Uh, we will see to that what is there in chapter 7. One of the important chapter, one of the important chapters, public finance. Chapter number 7. Chapter number 6 is national income. We discussed about national income. Chapter number 9, we went to chapter number 9 because it is little theory. So we need to know some theory in detail. So that's why first I did that theory. And believe me, chapter number 7, public finance is not the difficult one. It is an easy unit and more related to the common sense. It is more related to our common sense. That's why I've taken up this unit now, chapter. In that, the first unit, purely theory it is, little theory, but don't worry, this theory is related to our common sense and it is interesting one. Believe me, it is interesting one. Unit 1, which talks about, see, what is the chapter heading? Public finance. That means how the government will monitor or how the government will collect and spend that money. That is public finance. So in that unit 1, fiscal functions and overview, center and state finance. So fiscal functions, what are the functions and what are the overview? An overview about the function. Fiscal functions means government, financial, monetary authority, their functions, and that an overview, center and state finance. So center, the financial structure of the center and the state. एक मिनट. So that was hiccups. Uh, so this hiccups, no, that will. What do you do when you get hiccups? What will you do if you when you get hiccups? I'll give you one good idea. So usually you have to divert your mind. So divert your mind, but I have a good idea here. So you tell me, what is your idea? Let me see the chats. Chat. So I have some good ideas. The idea is you have to take a bottle. You have to take a bottle and you have to open it and close your nose. Nose. The holes of your nose you have to close. And what am I doing? I am breathing inside and I'm taking the same air. Sir, carbon dioxide, no, sir? Yes. So there should be more supply of carbon dioxide to your diaphragm. So if there is more supply of oxygen, then hiccups. So there will be hiccups. So what you can do is you can take a bottle or you can take a cover, plastic cover, and you have to close your nose and your mouth and you have to start breathing inside. So what it does, it will increase the carbon dioxide to your diaphragm. And hiccups happens because of that more oxygen in your diaphragm and that will start expanding. So now if you take more and more of carbon dioxide, if carbon dioxide increases in your body, so that will reduce the hiccups. So I always do that and it always works. It works within 1 minute. Within 1 minute or somewhere, in my case, it is not even 1 minute, 30 seconds. Within 30 seconds, I can stop that. Next time, whenever you get hiccups, no, try this. I'm so sorry if it won't work. In your case, if it won't work, I'm so sorry. Here. Yes. And it is very irritating one. Hiccups are very irritating one. Now, introduction. The government of all nations have important economic functions, even where market constitute the basic resource of allocation mechanism. Can you tell me what is this? Market constitutes the basic resource allocation mechanism. What is the meaning of this? What is the meaning of this? Nothing but market economy or capitalist economy. They are talking about capitalist economy. In case of capitalist economy, that is, even in case of capitalist economy, which plays the important role, government plays an important role. The size and scope of the government in market economies have grown much larger over the past few decades. Past few decades, may the importance of government has increased a lot. What governments do or do not do will obviously have an important impact on the economic performance of an economy and quality of life of its citizens. Obviously, it will affect us also. What government does, what government will not do. Now, government goes on giving freebies. Think. Government goes on giving freebies, free. Everything is free. So if they go on giving free, in future, the resources are there in the hands of those who doesn't know what is the value of that money or resources. Finally, we forget, being the citizens, we forget how to work. We are getting everything free, no? We forget how to work. So if we forget that, what happens now? We don't have the touch of working, how to work hard, that I don't know. If I don't work, what happens in the economy? There is no production. If there is no production, GDP reduces. Whole economy goes into tension, pressure. The whole economy will be in pressure. So that the freebies or something which you get in free, no, that definitely will not give you a good standard of living in the future. Right now, it might be giving you some good standard of living, but in future it will start affecting, and that there will be something called as uh, a pressure, economic pressure conditions that will worsen the situation, and we might go to the situation of Sri Lanka. That might happen. Okay. So what government does, what government will not do, that will definitely affect the life of the citizen. Government at various levels involved in several operations for running the state. Running the state. State means government. Oh, sorry. Here state is not government. It is the jurisdiction. State means jurisdiction here. For example, the government raises money from the various sources, such as it incurs expenditure also. Now, from where it will receive the money, it can be registration fees or GST or income tax, like this. So it will receive the money from various sources, incurs expenditure, consumes goods and services, borrows money, employs people, and provides key institutions such as property rights. We have experienced in our day-to-day life that though the government at various levels impose many rules and regulations in the economy, some matters still go unregulated. Some matters are still unregulated. So almost everything is taken care by the government, but some are still unregulated. Similarly, most of the goods and services that we consume are provided to us by private producers, but there is broad agreement that certain goods and services should be provided exclusively by the government. Okay. There are many goods which are given by the private, but there are some goods which should be exclusively given by the government. For a variety of reasons, we believe that government should accomplish some activities and should not do others. Some of the activities are should be by the government, and some of the activities are not by. For example, defense. Defense, it should be by the government. We cannot do that. And even if right is given to us, we might misuse. Not everyone, some might misuse that. Okay. Now in Rameshwaram Cafe, Bengaluru, Rameshwaram Cafe, mein, don't know from where the people start getting these explosives, from where they collect it, who is funding them. Obviously, terrorism. It is terrorism that is funding them. Okay. So terrorists are funding them. But still, we get one doubt. So that means security. In India, security system that is so weak. In Karnataka, the security system is so weak. And at the same time, the government, the personals in the government, they are giving some reckless statement. Their statement is that this bomb is not an organized way. It is not given in the people are not required to worry about. So it is not a dangerous bomb. Are bomb may very dangerous bomb or non-dangerous bomb. Bomb is bomb. I believe only one thing. Bomb is bomb. If you have done us, see, if you चोरी किया है, 1 रुपये का चोरी और 1 crore का चोरी, चोरी तो चोरी है ना. That is thief. There is a thief. He has stolen 1 rupee or 1 crore. He is a thief, no. There is no dangerous bomb or non-dangerous bomb. It is a bomb. That is what I believe. And there are some politicians who say that, don't worry, nothing has happened. It is not a bomb. It is nothing. And there is no need to worry about that kind of bombs. These kind of statements are given by politicians. And I request to those politicians that you prove that it is not dangerous. Do one thing. You sit on the chair, no? Keep that bomb in the beneath the chair, below the chair. You sit on that. Below the chair, you keep the bomb and you sit on that. And if when it blasts, no, if nothing happens to you, then I believe that it is not the dangerous one. So how dare you, or how dare that politician to give these kind of statements? It is dangerous. It is dangerous. So the politician is also dangerous. I believe that politician has given some money to that terrorist. I I think I have the opinion. I have this opinion. Any politician he is, if he's giving that kind of statements, then either he has to prove. I want he has to prove or he has to apologize. One amongst these two. He has to prove or he has to apologize for giving that kind of reckless statement, or he has to get down from that seat because you don't deserve to be in that seat. You are the elected representative of the people, and if you are giving these kind of reckless statement, that is not acceptable. At least if you stand to your statement, then prove that it is not dangerous. You create that kind of bomb with legal license. You have to create the bomb. You have to do some bomb with that legal license. Keep that under your chair, sit on that, and tell someone to blast it. If nothing happens to you, then I completely believe that it is not dangerous. And I will get one knowledge that there is something called as a bomb which is non-dangerous. I will get to know. I'll get one new knowledge. कैसे कैसे लोग रहते हैं यार यहाँ, and they call themselves as elected representative. They want that seat. I seriously doubt whether they are funding these guys. I seriously doubt. I have a doubt on them now if they are giving these kind of statements. Anyways, I don't know. The politicians, any politician is, I'm not targeting any politicians here. I'm telling politicians, if you are giving these kind of statements, then khabardar. You are not supposed to give these kind of reckless statements. Okay. Tell your politicians, the whomsoever it is, tell your politicians that it is wrong. You have to teach them a good lesson. As we know, macroeconomics, in the study of economy as a whole, there are three main macroeconomic goals of any nation. So the nation as a whole, we have some goal. Number one, economic growth. We have to make sure that economy is growing in a good percentage. We have to make sure that economy is growing. We have to make government as a whole, they have to make sure that economy is growing. If the real gross GDP, gross domestic product, gross domestic product grows at a faster rate than population, then people can, not can enjoy higher standard of living. So population is growing. Population grows at 10%, sir, but GDP is growing at 25%. Yeah, then it is a good sign here. The second goal is high level of employment, which will ensure higher income and higher output. The second here, first one is economic growth, nothing but GDP has to grow. Second one, high level of employment. Employment has to grow. We have to give more employment because आबादी तो ज़्यादा बढ़ रहा है यार. Population is increasing. That means employment should also increase now. Third macroeconomic goal is stable price levels. Inflation reduces real income and purchasing power of some people and disproportionately affects the lower income families. So if your income increases, my income increases. What about poor? Their income will not increase, no. Because of inflation, they are going to suffer a lot. So on the contrary, deflation signals a downturn in the economic activity, which may cause recession or even depression and large scale employment. That's why the third important goal is stability, to bring stability. What are the three goals? First one, to increase the GDP. Second one, to increase employment. And third one, for stability. We will discuss about all these points one by one in detail. So the government does not expect the economy. See here, listen. The government does not expect the economy to function automatically. Rather, it intervenes to direct them to function in particular direction. Such intervention on part of the government is based on the belief that the objective of the economic system and the role of government is to improve the well-being of the individuals and households. So remember, the government always makes sure that there should not be any automatic system here. Government will intervene just to reduce or increase. They might reduce the economic pace of economic growth, or they might increase the pace of economic growth. So this is the government intervention here. In this chapter, we are going to discuss about the intervention of the government. Intervention of the government in many ways. So we are going to discuss about that in this chapter. We will do one thing. Tomorrow, we are going to continue this unit. Okay, we will continue this unit in tomorrow's class. Right now, I would like to uh, put an end here. We'll discuss about this in next class. Okay, everyone, thank you so much for your patient listening. We'll discuss about other things in next class. Because the number of students who are watching also dropped heavily, dropped down. Okay. Thank you so much, guys. We'll meet in next class. Until then, keep studying, keep growing. Love you all. Bye.